Feroze, Reliance Industries, ICICI Bank, the numbers were constructive. They are 20% in terms of weighting of the Nifty 50. To what degree do those numbers give you conviction towards the broader market?
See, I think, Sri, if you look at those numbers and if you look at Reliance being the largest constituent of the index, I think in terms of demand for these stocks is going to be high because India is going through a paradigm shift with respect to passive index investing. And there is a lot of liquidity chasing these markets. The EPFO of India, Employee Provident Fund Organization, has invested a few lakh crores in the passive index, and that's why you see certain degree of momentum in these larger stocks. So I don't see a PE correction or a downward movement on the top 10 stocks of Nifty because in Indian rupees, if the total passive investing amount was just about $2 billion, today it is at about $50-60 billion, and that's supposed to be increasing. So I think liquidity seems to be chasing these Nifty stocks, and it's becoming a self-fulfilling prophecy of a higher PE ratio for these top 5-7 stocks of Nifty.
For us, on a sector level, the Adani fallout, is that now starting to fade? And do you want to own infrastructure? And what do you think the numbers will tell us about sentiment?
See, if you look at capital goods and infrastructure, there seems to be a reasonable valuation relative to other growth sectors like IT, and even auto. Have had relatively higher valuation. If you look at capital goods, infrastructure, and FMCG, those are sectors which are inexpensive, in our opinion. If not inexpensive, at least rightly priced. When you come to the Adani stocks, of course, they have had their share of pain in terms of the volatility. I think I would not be qualified to comment on a specific stock on the Adani group, but I think the pain is behind us, in my opinion.
Azeez, Feroze, excuse me, talk to me about how you reckon the central bank in India, the RBI, fits into the equity picture. Because when I try and connect the dots and I look ahead to a month and a bit, right, when the monsoon starts, forecast is for the monsoon this year to be normal rains, meaning normal crop, meaning no pressure upwards on food prices, which accounts for about half of the CPI basket in India. That should be constructive for equities, no?
Yes, Martin. Unlike the globe, we are looking at a 5.2% CPI number projected by RBI for this fiscal. And if you look at the long-term averages, we are well below the long-term averages of CPI, if I take 10 years as a reasonable period for a long-term average computation. And if you look at Jan to March, also the trend in terms of inflation easing out is reasonably accurate. 6.52 is what is the March number, whereas it was 5.66. 5.66 is the March number, whereas it was 6.5 for the Jan month. So I think 5.2 reasonable. It seems very reasonable, which is the projection of RBI. If that were to happen, the yield curve, which had become flat for India, which is very unusual, the 1-year GSEC and the 10-year GSEC hardly had any difference about 3 months back. I think that'll again be upward sloping very soon.